something feels off in the silver market right now. And it's not what most people think. Prices aren't exploding. Headlines aren't screaming. Social media isn't panicking. On the surface, everything looks quiet. But that silence is exactly what makes this moment dangerous. Because in past cycles, silver didn't move when people expected it to. It moved when pressure became impossible to hide. Right now, many are waiting for silver to confirm the move. They're waiting for momentum, for excitement, for validation. But silver has never rewarded that mindset. Historically, its biggest moves began when interest was low, conviction was weak, and the market appeared stuck. That's when the structure was already breaking beneath the surface. Silver is not like gold. Gold responds to confidence, to policy signals, to fear that's already visible. Silver responds to stress that hasn't been acknowledged yet. It reacts when systems tighten, when supply becomes inflexible, and when paper promises start to clash with physical reality. That process is quiet at first, almost boring, till it isn't. The most dangerous assumption right now is that nothing is happening because the price hasn't moved. But price is often the last thing to react. Before silver moves, other signals shift first. Access becomes more difficult. Delivery times stretch. Premiums stop behaving normally. Participants who rely on just-in-time supply quietly change behavior. None of that shows up on a chart immediately. This is where most people get misled. They think silver is weak because it hasn't followed gold higher. They interpret underperformance as failure, not realizing that silver often lags on purpose. That lag is not a sign of irrelevance. It's a sign of compression. Energy building with nowhere to go. In previous cycles, silver spent long periods frustrating everyone. It moved sideways while confidence drained out of the market. Analysts dismissed it. Traders abandoned it. Commentators declared it broken. And then, suddenly, the narrative flipped. Not because sentiment changed, but because the structure forced it to. What makes this moment different is the environment surrounding silver. Industrial demand is not optional anymore. It's embedded in energy systems, technology, and infrastructure that cannot simply pause because prices fluctuate. At the same time, investment demand doesn't disappear. It waits. It watches. And when it returns, it does so into a market that is far less flexible than most realize. The paper market gives the illusion of abundance. Contracts trade freely. Liquidity appears deep. But that liquidity depends on confidence that delivery can be met if required. When too many participants start asking the same question at the same time, the illusion weakens. And silver, more than any other metal, exposes that weakness quickly. The real risk right now is not missing a rally. The real risk is misunderstanding the phase we're in. Silver isn't rising because it doesn't need to yet. The pressure is still being absorbed internally, but absorption has limits. And when those limits are reached, the adjustment is rarely smooth. This is why the lack of movement matters more than sudden spikes. Calm conditions allow imbalances to grow. They encourage complacency. They convince people that tomorrow will look like today. That's how markets set traps, not with chaos, but with quiet. And if you're only watching price, you're probably missing what silver is actually telling you right now. As the cycle develops, the pressure inside the silver market doesn't release all at once. It concentrates, and it tends to show up first in places most people aren't watching. Not in headlines, not in daily price moves, but in behavior. One of the clearest signs appears when the market stops responding logically to news. Normally, silver is expected to react to inflation data, rate expectations, or central bank messaging. But during compression phases, those signals lose influence. Silver ignores good news and shrugs off bad news. To casual observers, it looks broken. In reality, it's becoming insulated. This insulation happens when physical demand quietly absorbs available supply while paper trading continues to set the visible price. As long as confidence remains intact, the system holds. But confidence is fragile. It depends on the belief that obligations can be met without friction. The moment that belief weakens, even slightly, behavior changes fast. This is when participants begin to prioritize certainty over efficiency. Instead of relying on future delivery, they seek immediate access. Instead of optimizing price, they optimize availability. These shifts don't make noise at first. They don't trigger alerts. But they tighten the market in ways that are difficult to reverse. At the same time, the gap between physical reality and paper representation widens. Contracts continue to trade as if supply is abundant, while real-world inventory becomes less flexible. This gap can persist longer than expected because it's supported by habit and trust. But once challenged, it collapses quickly. Another key factor is silver's dual role. Unlike gold, silver is consumed. It leaves the system. It's built into products, technologies, and infrastructure that aren't easily reversed. That means supply isn't just a function of mining and recycling. It's a function of permanence. Once silver is used, much of it is effectively gone. That creates a problem when investment interest returns. Unlike gold, which largely remains available above ground, silver's availability is constantly eroded. The market relies on a delicate balance between production, consumption, and confidence. When any part of that balance shifts, the adjustment tends to be sharp. This is why silver's biggest moves often feel disconnected from the narratives that precede them. The story catches up after the fact. The move isn't driven by excitement. It's driven by necessity. Right now, many are focused on what silver isn't doing. They're waiting for confirmation. They're waiting for a signal that feels safe. But silver rarely provides that comfort. Its most meaningful moves occur when positioning is light and skepticism is high. The danger is not that silver is being ignored. The danger is that it's being misunderstood. A market that appears calm while internal stress builds is not stable. It's constrained, and constrained systems don't unwind gently. The longer silver stays quiet in an environment that should, by traditional logic, support higher prices, the more tension accumulates. That tension doesn't disappear, it transfers. And eventually, it expresses itself in a way that forces attention. This phase doesn't last forever. It never does. The question is not whether silver will respond, but how abruptly the response will be once the system can no longer contain the pressure. And when that happens, the explanation will sound obvious in hindsight. But by then, the conditions that made preparation possible will already be gone. When the silver market finally transitions out of this phase, it rarely gives advance notice. There is no countdown, no clean signal that everyone agrees on. The shift happens when the system reaches a point where flexibility disappears. When confidence that supply can respond on demand quietly breaks. At that moment, price is forced to adjust, not because sentiment changes, but because reality intrudes. Silver doesn't reprice to attract buyers. It reprices to ration availability. That distinction is critical. One is optional. The other is mandatory. This is why silver's moves often feel sudden and disorderly. The market spends months, sometimes years, absorbing pressure internally. Then, over a much shorter period, it releases that pressure externally. Participants who are waiting for confirmation discover that confirmation arrives at the worst possible time. What makes this especially dangerous is how quickly conditions change once the adjustment begins. Access tightens, volatility increases. Narratives flip, and the same voices that dismissed silver as stagnant suddenly frame it as unstoppable. By then, the opportunity has shifted from preparation to reaction. This pattern has repeated more times than most people realize. Each cycle looks different on the surface, but the mechanics are remarkably consistent. Silver underperforms while stress builds. Confidence masks constraint. And when confidence weakens, silver responds with force. The current environment contains many of the same ingredients: elevated debt, fragile supply chains, heavy reliance on financial instruments that assume smooth delivery, and growing demand for silver that cannot simply be switched off. None of this guarantees an outcome, but it does define a structure that is increasingly sensitive to disruption. This is why the lack of movement right now should not be interpreted as safety. Stability in a stressed system is often temporary. It exists not because conditions are healthy, but because adjustment has been delayed. And delayed adjustments tend to be more violent when they arrive. Silver isn't rising yet because it doesn't need to. The pressure hasn't reached the point where it must express itself through price. But that pressure doesn't dissipate on its own. It accumulates. And when accumulation reaches its limit, the market chooses the only path left. For those paying attention, the most important question is not when silver will move, but whether the current calm is being mistaken for balance. History suggests that assumption carries risk. Silver doesn't warn loudly, it warns quietly. And the most dangerous moments are often the ones that feel uneventful. By the time silver starts making sense to everyone, it usually matters less who is right and more who is ready.